Have you ever looked at your paycheck, saw the number you earned, and then looked at what actually landed in your bank account? And for just a second, you wondered, wait, who got paid more than I did? Because before your money even reaches you, taxes have already taken their slice. Now here's the strange part. Someone making $50,000 a year can end up paying a higher effective tax rate than someone making $5 million. That sounds impossible, right? It sounds unfair. And honestly, it kind of feels like it shouldn't work that way, but it does. Consider Warren Buffett, the man who literally said the rich should pay more taxes. And then he admitted something that should make your blood run cold. He pays a lower tax rate than his own secretary. His office staff paid an average effective tax rate of 32.9%. Buffett paid 17.7%. And here's the kicker. He said, and I quote, "I have no tax planning. I don't have an accountant." That's the moment you realize the game isn't what you thought it was. You're playing checkers. They're playing chess on a board you didn't even know existed. Look, taxes matter now more than ever. Inflation has quietly pushed everyday expenses higher. Housing costs have climbed. Food isn't getting cheaper. And in many countries, tax brackets haven't always kept up with rising incomes. So people feel squeezed from both sides. Higher living costs, higher tax bills, lower breathing room. Meanwhile, a Berkeley study found that the richest 400 households in America pay an effective tax rate of 24%. The rest of us? 30%. Let that sink in. The people with the most money, the people who can most afford to contribute, are paying a lower percentage than you are. And it's not because they're cheating, it's because the system was built for them. Most people think taxes follow wealth. In reality, salary taxes usually follow income. And income isn't the same thing as becoming wealthier. That tiny distinction changes everything. Imagine two people. Sarah is a software engineer. She earns $200,000 a year. Every paycheck arrives already smaller because income taxes, payroll taxes, retirement deductions, they've all taken their bite. She barely gets to touch the money before it's taxed. Now meet David. He also becomes richer by about $200,000 this year. Except David owns apartment buildings and stocks. His properties increased in value. His portfolio grew. On paper, he became richer by the same amount, but much of that increase isn't considered taxable income yet. No tax bill arrives simply because your shares became more valuable. It's almost like owning a painting. If the painting becomes more valuable hanging on your wall, nobody knocks on your door demanding taxes because collectors suddenly like that artist more. Ownership lets wealth quietly grow. Employment gets taxed while it's happening. That's the structural flaw. The system doesn't reward people who earn money. It rewards people who own things. Let's start with the simplest trick. Elon Musk took a salary of exactly $0 from Tesla in 2024. Jeff Bezos earns $81,840 a year, low enough that he actually qualified for the child tax credit. He took it. Think about that. The richest man on the planet claimed the child tax credit. How? Because they don't take salaries, they take stock, and stock isn't taxed until you sell it. Here's the math. Wage income is taxed at up to 37% federally. Long-term capital gains, 20%. That's a 17-point difference. Just by calling your compensation investment return instead of paycheck, you've slashed your tax bill nearly in half. The psychological insight. We're conditioned to think a salary is the marker of success. The bigger the paycheck, the more successful you are. But the wealthy have decoupled income from wealth. They don't care about the salary. They care about the asset. Strategy 2. Buy, borrow, die. This one is almost poetic in its elegance. And honestly, once you understand it, you'll never look at a billionaire the same way. Step 1. Buy assets that appreciate. Step 2. Instead of selling those assets to get cash, which would trigger capital gains tax, you borrow against them. Loans are not taxable income. Step 3. You die. And when you die, your assets get a step up in basis. The cost basis resets to the value at the time of death. Your heirs can sell it the next day and pay zero capital gains tax on all the appreciation that happened during your lifetime. Oracle founder Larry Ellison doesn't take a taxable salary. Instead, he borrows against his stock. Over $30 billion worth of it. Elon Musk has done the same thing, borrowing billions against his Tesla shares. You can live like a king. You can spend billions. And you never pay a dime in income tax on that spending because it's not income, it's debt. And when you die, the debt gets paid off and your heirs inherit everything tax-free. The irony is almost too much. The very thing that crushes most Americans, debt, is the thing that makes the rich richer. You take on debt to survive. They take on debt to thrive. Strategy. 3. The carried interest loophole. This one is a masterpiece of linguistic engineering. When you work a job, you get a salary. That's ordinary income, taxed at up to 37%. When you invest your own money and make a profit, that's capital gains, taxed at 23.8%. Simple enough. Now imagine you manage other people's money. You do the work of managing that money. But instead of calling your cut a management fee, which would be ordinary income, you call it carried interest, a share of the profits. And profits are capital gains, so you pay 23.8% instead of 37%. Just 8 top executives at Blackstone and KKR dodged a collective $335 million in taxes using this loophole from 8 people. The psychological trick here is about labeling. The same activity, managing money, can be taxed at 2 completely different rates depending on what you call it. It's not about what you do, it's about what you name it. Strategy 4. The charitable trust shell game. This one will make you question everything you thought you knew about philanthropy. NVIDIA CEO Jensen Huang is worth about $127 billion. In 2016, he transferred over 3 million shares of NVIDIA stock, then worth about $100 million, into something called a GRAT, a Grantor Retained Annuity Trust. Here's the beauty. The stock goes in. Any appreciation above a certain rate passes to his heirs tax-free, because the IRS assumes a modest growth rate. When NVIDIA's stock skyrocketed, the excess went to his beneficiaries completely untaxed. But wait, there's more. Huang also donated $330 million worth of NVIDIA stock to his family's charitable foundation. That donation is tax-deductible. The foundation gives away some money each year, enough to satisfy the rules, but the bulk stays invested. And when Huang dies, his family controls the foundation, which means they control the money. This is the dark genius of charitable trusts. You get the tax deduction now. You keep control of the assets. Your family gets the money eventually, and the government gets nothing. Some of the biggest philanthropists in the world are running the most sophisticated tax avoidance schemes ever devised, and we call them heroes for it. Strategy 5. The geographical arbitrage. Sometimes the simplest solution is just leaving. Jeff Bezos moved from Washington State to Florida in early 2024. Washington has a capital gains tax. Florida has none. The move saved him an estimated $1 billion in state taxes. $1 billion, just by changing his mailing address. And here's the thing, this isn't just for billionaires. If you live in a high-tax state and you can establish residency in a no-tax state, you can save a significant chunk. The wealthy just do it at a scale that's almost incomprehensible. It's called tax competition. States compete to attract the wealthy by offering lower rates, and the wealthy play them against each other. It's not illegal. It's not even immoral, depending on your perspective. It's just rational. If you had $1 billion, wouldn't you move to save $1 billion? Here's what nobody tells you about all of this. Every dollar that the wealthy avoid in taxes is a dollar that someone else has to pay, or a dollar that doesn't get spent on roads, schools, or healthcare. The tax burden doesn't disappear. It shifts. The top 5% of earners already pay 61% of all income taxes. The middle class is carrying this country on its back, while the ultra-wealthy play a game of legalized avoidance. And here's the psychological twist. The wealthy genuinely believe they've earned their wealth. They see taxes as theft. And because they control the narrative, they fund the think tanks and the media, they've convinced the rest of us that this is just how the world works. But it's not. It's a choice, a system designed by the wealthy for the wealthy. Now look, you can't replicate these strategies at scale. You don't have billions in stock to borrow against. You don't have a private equity fund to structure. But you can shift your mindset from income to assets. Take 10 minutes this week to understand every tax-advantaged account available where you live. If you invest, ask yourself, are you investing or simply trading? Constant trading interrupts compounding. It pulls the drain plug on your bathtub. And before making any major financial decision, ask one question most people never ask. What's the tax consequence? Sometimes that single question is worth more than finding a slightly better investment. Because keeping an extra dollar often beats earning an extra dollar. One requires taking more risk, the other simply requires understanding the rules. So the next time you look at your pay stub and see that number they took, remember this. It's not because the system is fair. It's not because everyone pays their share. It's because the people who wrote the rules wrote them for themselves. Buffett pays less than his secretary. Bezos claimed the child tax credit. Ellison borrows against billions in stock. Huang avoids $8 billion through a charitable trust. And they all sleep perfectly fine at night. The tax code is less like a punishment and more like a map. Most people see a maze. The wealthy spend years learning the roads, same destination, completely different journey. The question isn't whether the game is rigged. The question is, now that you know the rules, will you keep staring at the maze, or will you finally start studying the map?